These are very desperate times, and desperate times often see desperate measures, desperate policies, and desperate dishonesty. We are at the end of a credit cycle. That's very boring. It sounds like a term of art, but the end of a credit cycle, and since fiat money is credit, it's also the end of a fiat money cycle. It's the end of a dollar cycle, and it's the direct consequence of a massive debt cycle. And debt, currencies, precious metals, and military complex and geopolitics are all connected. And of course, neither you nor myself in the investment space pretend to be an expert on geopolitics, but we have to address geopolitics. None of us really knows exactly what's going to unfold or what the financial motives of every party was and what the wisdom was. We have a lot of questions. I will say it reminds me again of a quote I have used so many times in written reports, from someone who's not a financial expert, Ernest Hemingway, a fiction writer, but also a direct veteran of the First World War and a participant in the Second, very familiar with the Spanish Civil War. But he said, look, when you have debt-soaked nations, that always leads, that debt, like a credit card binge, it always creates a temporary prosperity. And that temporary prosperity can last decades. And we've certainly seen that in the S&P and the risk assets and in the top 1 to 10% of the US population and in Europe as well. But that temporary prosperity is always followed by what he called the permanent ruin of currency debasement and war. And currency debasement and war are very linked because wars are, maybe they're ideological, but they're typically financial. And I hate to be so second or third derivative or reductionist, but conflict comes from financial stress, whether it's the US Civil War, whether it was the Second World War post-Weimar, pick a conflict. There's usually a financial motive or a desperate economic backdrop to it. Now, when Hemingway said that, that was in a pre-nuclear era, the stakes are higher. Either the comfort or the fear is higher, depending on, some people think it's just too much madness. In a nuclear era, we can be protected. Others think there's too much to lose. This is crazy. But again, not wishing to be an expert on what's going to happen next or who's to blame, we have to look at these things without pretending to have a moral compass here or to be right and everyone else is wrong. But we have to look at things objectively without a bias or try without a bias. And again, with the topic of conflict and war, whether it's in the Ukraine, where you've had, objectively over 1.5 million Ukrainians killed, not to mention how many more were maimed, in what Jeffrey Sachs and many others have called a completely avoidable war, then that's a question. But regardless of our views on that war or what we think of Putin or Zelensky, we should all be appalled by that number in such a short period. And we should be appalled by the images of young men being pulled off the streets into vans and taken to the front line where the average life expectancy is less than a week. That should just be appalling. And again, I'll tie this into financial matters, but in Gaza, which has a population of 2 million, there's at least 50,000 dead. Whatever your views are in Israel or Palestine or Gaza or the West Bank, we should all be appalled by that. I think it is important to ask questions without being sanctimonious about the answers. There are some like John Bolton or Lindsey Graham or certainly Netanyahu or the famous quote by Isaac Herzog that there are no innocents in Gaza. Everyone's Hamas, everyone's Hezbollah. I think that's really reductionist and dangerous way to start. And I think you have others like Gideon Levy or Miko Peled, who wrote this famous book called The General's Son, or certainly Norman Finkelstein, or even the South African International Court, which is questioning the morality of what's happening and what is, they say, an apartheid state. Now, you can have different views on that, again, but I think we should all be concerned about the human costs. We all know in the Iraq War, we didn't get the true narrative on weapons of mass destruction. I have a question about Tulsi Gabbard in March telling the Senate and the Congress that she's the head of all intel, and they share intel with MI6 and even Mossad. At least as of March, there was no nuclear threat out of Iran. So again, do I know? No. But Tulsi Gabbard has been quiet for a long time since the ceasefire. We have to ask, what is the truth? We've all seen Netanyahu, who doesn't, again, represent all of Israel, come to the U.S. many, many times over the last 20 years, saying that Iran was seconds away from nuclear weapons. I don't think any of us really know. The War Powers Act, does Trump really have the right to sneak in a surprise attack? Is that for national security, or is that following someone else's foreign policy to the risk of our own detriment? These are questions I don't have the answers for either. AIPAC, you saw the Tucker Carlson, Ted Cruz interview. Is AIPAC just a benign influencer, or is it a powerful influencer on U.S. foreign policy? There are strong arguments on both sides. John Mersheimer wrote a book many, many years ago that just got him pilloried in the academic community. Now he's more credible. He was just as credible then, but that was a sacred cow you couldn't critique. And we have to ask, why can't we critique that? But I do think, to my original statement, desperate times create desperate measures. I think the war in Iraq, Syria, Afghanistan, Libya, and many others would agree, regardless of your political bias, were not wars of Operation Freedom or bringing democracy and comfort to those countries in the Middle East. Like, they were very much driven by oil. I've talked to Doomberg, the brilliant chicken head. We had a great talk on energy, and he said very clearly, energy is life. It's a base layer of money. This is getting into the economics of war. If we're talking about if we burn energy to produce and pay for things, the power is not in the currency. The power is in the oil. There is power in energy. Iran has 30% of the world's oil. It has control over the northern bank of the Straits of Hormuz. Yes, if we could have a regime change in Iran, that would help U.S. in a way to have a friendly component to that oil trade. It would certainly handicap India and China that have benefited from the dark oil that's come through these teapot refineries and these false flag, these fake banner Iranian ships bringing oil to China and India. But again, there are economic motives. I think any of us who've sat through the last 15, 20 years of post 9/11 foreign policy in the Middle East and in Afghanistan, and frankly, even the rare earths in Ukraine, there is a financial motive behind our policies. Whether there's a morally good justification for that is up for each of us to determine on our own. And I, as a bond trader and a precious metals expert, I'm not here to give the final answer on that. But I think these are very, very important questions. And I think in terms of the markets, when we're talking about conflict, because I think it also is a matter of this kind of cognitive dissonance, this kind of almost indifference at the market level. I mean, what was amazing to me about the recent headlines, I'm not even getting into the Ukraine debate, is just the S&P, the NASDAQ, and the Dow was like a Zen monk. And not only was it like a Zen monk, the S&P, the Dow, and NASDAQ actually went up. Oil went down 5%. When we're looking at ceasefire, tenuous, war in the Middle East, Straits of Hormuz, Iran, Israel, oil went up, gold went down. But risk assets like equities went up. It's fascinating. I've joked many times over the years, as you could drop a nuclear bomb on Cleveland and the markets wouldn't hiccup, as long as they know the Fed is there to provide liquidity. We've just become so, I want to say there's that moral hazard. After 9/11, New York real estate tanked by 15 to 20%. Within a few months, it was back up. And I think these crises at a market level, at a cold financial level, are just dip opportunities. Buy at the bottoms, buy at lows, or buy at temporary pullbacks. There's been kind of a realpolitik, an indifference to the human, all too human sadness, the numbers, which are becoming abstract, and just, hey, good news is bad news is good news. If there's a war, we're going to see more QE, we're going to see more Fed support, we're going to see lower interest rates, risk on. When it should be, we should be very concerned about the risk of nuclear weapons in the Middle East, or even, I would call that a Pearl Harbor strike. We were in negotiations with Iran when we did that surprise strike. That's exactly what the Japanese were doing with us when they did Pearl Harbor. So there's questions about this, but the markets, they seem to know, that they have this support from this, they think, immortal Fed and this immortal liquidity and this constant support, this constant airbag, which we'll get into, is a complete fiction and it's an illusion of temporary prosperity, to Hemingway's point. But even, as Martin Armstrong said, the Taco Tuesday, the Taco Trump, that whatever he says lasts about 30 minutes, then he pulls back, like Liberation Day, speaking very strongly or talking about bombing Iran, but then pivoting very quickly or changing policies very quickly when things go wrong. And so there's a sense that, the world's become kind of hardened or softened, you could say, to the tough talk of Trump. And that's dangerous too, because Trump is very psychologically averse to being critiqued. So if they think he's soft, he'll get harder. But again, this market reaction was staggering. And I think there is a sense that we're really kind of experimenting as we go. The markets are really indifferent to the human suffering. Crises are actually opportunities because of this moral hazard that they think this liquidity is always going to be there in some form. And it could be true argumentatively that the liquidity is always there, that there's never a dip that can't be rebought. But again, I'll say this, and this gets into debt, the dollar, and currencies and precious metals. You can continually support a market, including a market on the brink of nuclear war, but you can only do that at the expense of the currency. And that, of course, is why we're seeing gold at all-time highs. The dollar down 10% this year. It's worst first half of a year in 40 years. And the world moving away from the dollar. All of this is connected. The dollar, the debt, the currencies, the credit cycles, again, and war. And I think alternative media has, whether it's, Alex Craner or whether it's Jeffrey Sachs, obviously I have a bias towards these folks as opposed to Fox or CNN. But thank God we have that. And platforms like this to at least raise the questions. And again, it's sanctimonious for me to give the answer. My view on Israel, my view on Palestine, my view on Putin. That's not really helpful. I'm a precious metals guy. I'm a bond guy. But I think we're all human beings and we should be asking these questions. And before we answer them, we should look at both sides, whether it's John Bolton or Miko Peled or Gideon Levy. They're all relevant perspectives. You don't have to agree with them, but you should know them before you just start spouting emotions and making conclusions when there's this many lives at stake and more to come. And I don't know how it plays out. But these are desperate times in the currencies, in the markets, at the central banks, in politics, at the social level because of the inflation, invisible tax, and the centralization. These are very pressure cooker times for every one of us. And yet the markets rip on and they continue to live on the Pavlovian power of, if the dovish Fed or a dovish central bank is behind us, nothing can stop us. And as long as there's that instant liquidity, party on. Yeah, it's a very important question. I mean, a couple of things, like Michael Burry a couple of years ago said he considered ETFs one of the most dangerous instruments in the markets. Most people know what an ETF is, but in the simplest terms, if you have a bag of marbles and maybe 3 of those marbles are very valuable and the other 50 marbles are kind of unvaluable, but those 3 powerful marbles in an ETF will keep the rest of that bag valuable. If you're investing in the ETF, even the other 50 unlovable marbles are going up in price because the volume of liquidity going into the ETF pushes all ships in that rising tide. And if you've got a couple big names in that tech ETF or all tech ETF, whether it's NVIDIA or the fabulous 7, they can draw in and bring in liquidity that lifts otherwise unlovable equities in. And so that creates an artificial inflation of all assets. Of course, the opposite would be true if NVIDIA or Google or Facebook takes a dive or Amazon takes a dive. Those healthy marbles bring everything back down. So they rise and fall together. And as Gunleck says and others, markets climb upstairs and they take an elevator down. If something does go wrong, and there's a million things that it could, that's an obvious threat. So the proliferation of ETFs, which sovereign wealth funds and 401k programs and even family offices, but your average investor, they run to those ETFs. Even traders trade ETFs and inverse ETFs. So they create this massive amount of demand from the few good marbles that lifts the price of all the other marbles. And that creates massive asset inflation. Of course, if you have a dovish Fed that's pivoted from rising rates, which failed to beat inflation and just caused, fiscal dominance and put Uncle Sam in a corner, if you now have a Fed that's lowering rates and probably going to either stay or lower further, and probably on the brink of QE at some point, we can get into why, that also is a very bullish tailwind. And of course, the Fed, like every central bank, has to choose between its bond market, its debt market, and its currency. And because debt is the rotten wind beneath the wings of every economy really today, except for maybe ironically Russia, if debt and issuing credit and issuing sovereign bonds and IOUs is essential, to stay alive, you have to keep the yields on those bonds down. You have to keep the interest rates down. So you have to create artificial liquidity to save that bond market, because if the yield on the 10-year treasury, and this is the stock mind in my past, I know that if the yield on the 10-year goes above 5%, that means the cost of debt gets too high. That means equities go down. So right now, to answer your question, I think Michael Burry is right. These ETFs are temporary prosperity, which can lead to permanent ruin because they rise on rising tide of liquidity and low rates, and they tank if there's a needle that pops that system. And then all things go down. So between the ETF demand, a dovish Fed with a lower rate policy than it has 2 or 3 years ago, those two tailwinds are massive. And then again, the constant moral hazards, a whole generation of young traders coming in who've never really seen a bear market, who weren't there in 2000 or 2001 with the NASDAQ, or certainly weren't there at the GFC even. They've been conditioned to believe that we can have deficits without tears, and that a Fed will always be there to protect these markets. And that, as I said, every crisis is a dip, every dip is an opportunity. The high frequency trading, algo AI, mega computing trading is also kind of touted as this new savior. We can avoid risk through these algorithms, and the high frequency traders are a massive percentage of the daily trading going on in the markets. That was true even when I was trading. And I know folks from Dallas to New York to Singapore who trade that way. They're not all brilliant. There is no easy answer, just like AI isn't an easy answer, but there's no doubt that that keeps a constant kind of electronic algorithm of demand going. And the signals that they would typically look at to sell it in a radical way are the same as the signals they would look at to buy in a radical way. And without getting, and I'm not a high frequency trader, but I certainly know that those programs are based on the cost of debt and interest rates and spreads between junk and between sovereigns. And those spreads are tight right now. And again, when you look at the markets, you can say, well, Piepenburg's just a precious metals guy. He's a perma bear. I'm not. I've been risk on many times. I was risk on when we had unlimited QE in 2020. I was risk on in 2024 when Powell was announcing potential rate cuts. We knew they were coming. They didn't come till September, but just the announcement. So I'm not a perma bear, but I know realistically these are not sustainable markets. And again, as a precious metals guy, I'm less interested in speculation these days, but people I know are traded with or invested with, whether it was Ray Dalio or Jeremy Grantham. I loved his fund. He was a great manager. Paul Tudor Jones, even Pimco, Druckenmuller, they are just, if not more bearish than I am, and they are following risk assets. But this brings us to the world of, McKay and Graham and Farrell. McKay was talking about the madness of crowds. This is the madness of crowds, these chasing these tops, this belief that the Fed will save you, this fear of missing out, this let's get more alpha out of a very Fed-supported market. That is a madness. And it is euphoric during that temporary prosperity, but it is a very brutal karmic kick in the gut when things go wrong, and we can talk about those could be. And again, Bob Farrell, the guy who said the most important and overlooked power in the markets is mean reversion. That rubber band that goes up, comes down, it goes down, comes back up. Mean reversion would put the markets at 50 to 75% less than they are right now. That's a normal market cycle. Again, interrupted by the absolutely unnatural force of a central bank monetizing the bond market and therefore effectively, indirectly monetizing the equity markets.